Hi, this is Michael.
Hi, my name is Ray. Welcome to another episode of Ray's Economics Clue Book. Today we're talking about exchange rate policy.
Yep.
So basically, what is exchange rate policy? Well, first of all, let's say you don't really have an exchange rate policy. You just let your currency exchange rate float, a free floater.
Yeah.
UK is somewhat an example of this. It basically has a free floating exchange rate policy. Not exactly, but however, let's just say the UK has one, and basically, fall in the British pound basically depreciation rise appreciation. Right now the British pound is a lot lower than what it was about 10 years ago. During 08. At 08 it was about $2. Right now it's about 1.24 US dollars. Especially fell in 2016 after Brexit for obvious reasons, political instability, things like that. But it's a lot lower than how it was 10 years ago. So who benefits in Britain from a lower depreciated currency, lower sterling? Well, obviously exports. UK exports benefit because their export prices are now relatively cheaper compared to the rest of the world than they were 10 years ago. So businesses supplying exporters, also it's a chain effect. Exporters and the businesses that support them and so on are all benefited. UK forms of overseas profits also benefit. And finally, farmers with euro support payments, because this leads to depreciated currency is basically the same as eventual inflation. So this all leads to higher value on a nominal level for many things. But what people lose is basically the opposite end of the opposite side of the coin, which is importers. Importers, business that needs imports, business that need capital imports. Consumers, mainly consumers too. Consumers are one of our biggest importers, obviously. They all suffer because now everything is more expensive.
Exactly.
Weaker sterling leads to more expensive goods, overseas prices, and also inflation back home. And so this causes some high prices and difficulties for consumers. However, it's important to mention that exchange rates are basically heavily affected by the exchange rate forex market by investors. And a 10% depreciation of sterling is equivalent to 1.5% cut interest rates in the UK. Why? Because the cut interest rates decreases demand for the sterling, for the pound. And this causes depreciation or lower value for the sterling, which is depreciation.
I think the important thing here is when it's flexible, exchange rate. Basically, it's a free market. It's actually more aligned with your natural business cycle, right? More natural with your economics. So if your economics is really white hot, then your exchange rate shoot up. Okay. If your economic is at risk, like Brexit, right? Makes a lot of risk in the future. It makes the UK economy much less predictable. Then boom, plummet. Okay.
So what about fixed exchange rate? Let's say theoretically exchange rate is strictly fixed at current level, and let's say the market exchange rate is lower than your fixed exchange rate. So you need to increase your exchange rate to reach your fixed goal. So what happens now? To increase your exchange rate to a fixed level, the government needs to step in. Much like in fiscal policy, they increase demand. In the forex market, government creates demand by buying, say, genos in this fictional currency. They buy genos to increase exchange rate.
This is a hypothetical government. And when we say fixed exchange rate in forex market, we will call that a pegged currency. Right? Pegged to US
dollar.
To
reach the pegged exchange rate, basically to increase it to the pegged exchange rate, you can increase demand by buying a currency, buying genos, which increases demand obviously. Two, you can instead indirectly affect demand by having a central bank frankly just talk. If your central bank says we're going to increase the interest rate, then obviously people want to buy your currency because they want to invest in your financial assets, which now all have higher interest rates and higher returns. And so this increases demand indirectly in the forex market, which increases your interest rate as well.
Or finally, they can just capital control. For example, I just don't make the overnight borrowing rate so high, so you cannot really borrow borrow the money then to short sell. Because in this case, a lot of people, short sellers, want to speculate, right? Because they know the equilibrium is about 1.2, but the Geno government is going to be 1.5. They want to increase, so they're going to just speculate. But if the borrow the Geno to short sell the Geno currency is so expensive, makes the transaction so expensive, right? Then this will make actually a lot of speculators will just
so they can limit
get out.
They can limit or even eliminate virtually some financial transactions that will impact the exchange rate for a geno. Now, at opposite end of the spectrum, if we need to decrease our exchange rate to reach a pegged exchange rate because our market exchange rate is too high, we can do the exact opposite as the government. The government can sell genos to decrease demand. The government, central bank can talk about decreasing the inflation, decreasing the interest rate to indirectly decrease demand, or capital control. We can perhaps limit the buying of genos, for instance, just government policy, limit the purchase of genos to decrease demand as well.
It actually happens when the Geno government they really has a very good white collar economy, right? And the U.S. is comparatively weaker. Therefore, the equilibrium rate could be, let's say, 1.8. Now it's exactly opposite as Ray just mentioned. Will happen. Okay, so basically in the real world, actually there are quite a few pegged example. For example, Hong Kong dollar, right?
Dollar, yes.
Hong Kong pegged with US about 7.8. Okay, so for example, Saudi Arabia.
Yes.
Right.
And so the benefits and cons of a pegged currency or inflation or basically controlled exchange rate. Basically, you remove uncertainty in your exchange rate, obviously, because you have a pegged exchange rate.
Yeah.
And you control inflation because exchange rates are correlated with inflation strongly. So by controlling exchange rates, you control inflation, obviously. But you lose your monetary policy independence and your exchange rate independence because now your monetary policy is dependent on another country because you're pegged to that country's currency.
Yeah, it's for the tit for tat, right?
So if you're pegged to US dollar, whatever happens to the US, you're dependent on it now because you need to control your currency to peg it to the US dollar.
Yeah.
So to review, basic different types of strictness in monetary and exchange rate policy. You have a flexible exchange rate. You have a clean float or managed float, like in the UK or many countries. Basically, a managed float basically allows a lot of flexibility, but you still need to keep it within a certain range, perhaps. And then after that, you reach another level. You reach a level where you're basically pegging your exchange rate. You're fixing your exchange rate, and then finally you have the most extreme levels of exchange rate policy, which is monetary union. Basically, for instance, the EU. The euro. It might as well be called the European Monetary Union because that's the most prominent and most well-known, obviously, monetary union. Basically, the euro, your country loses its entire monetary independence because you share the same currencies as many other countries. So the euro, one problem is, say, Greece, which is a very high-tech and interesting, I should say, economy, and the Germany, which is a lot stronger economy. They both have different fiscal policies, but they have the same monetary policy now because they're under the same currency. That creates a lot of economic complications and monetary complications, obviously. So also Greece's central bank loses all of its power, basically.
And the same for the German central bank. For example, German central bank may opt to increase the interest rate, but Greece might opt to reduce the interest rate. But they both have no say. Right, so
and so this creates a lot of problems, but it has some benefits, or else obviously it wouldn't be done. And so you basically lose all your monetary policy independence the further you go down to the left. But you have a stronger anti-inflationary effect because your inflation basically is like exchange rate is pegged now. And you have credibility exchange rate commitment the more stricter you go. So for our final clue is basically floating and fixed exchange rate have trade-offs. With a floating exchange rate, you have independence in your exchange rate and monetary policy. You have inflation risk, but you have more flexibility in your policy because you're floating, so you're not tied to a certain exchange rate.
You are more aligned with your own economic cycle.
But with fixed exchange rate, you have less flexibility. You have to catch on because you have to peg yourself to a certain exchange rate, no matter the conditions of your economy or the conditions of anything, basically. But it controls inflation because you control your exchange rate, and you're dependent on another country basically now. Depending on what you're pegged on, you're just dependent because you lose independence in your monetary policy.
We call that tit for tat, right? So it's like Hong Kong central bank usually, they have to follow whatever the Federal Reserve Bank doing. If the Federal Reserve cut interest rate, Hong Kong usually overnight they will cut the same amount of interest
If Hong Kong
rates.
did not peg it, then no matter what US dollar, the US would be irrelevant to Hong Kong's monetary policy. But since they do peg it, they're basically dependent on US monetary policy.
Exactly. So they want to make sure that the peg is predictable and is as solid as they want the investors to believe.
Yes.
Okay. So I'll see you next time. Bye-bye.
Bye.